Alright guys, welcome back. I hope you're all well. Unfortunately, I've been ill all weekend, so I do have a bit of a raspy throat. So I hope you can hear me well. I'm going to try to keep the monologue brief this week and just get into the charts to save my voice a little bit. I'll try to edit the coughing out, but if a few slip through, then I apologize in advance. Again, I'd like to say thank you for the feedback for last week's lecture. ICT is like a jigsaw puzzle. There's many pieces that you have to put together. And what I showed last week in the advanced gap theory lecture was something that was hugely pivotal for my development using ICT concepts. When I was able to recognize where gaps are likely to form inside of a dealing range, I was able to predict where we are within that buy or sell program. The more you learn and the more you train your eyes, the better you're going to get at this. The most important thing is that you're consistent in your studies. You're consistent in your learning. The more you rush this, the more frustrated you're going to get. And you're going to find that it's not just as easy as looking for patterns. Without narrative and context behind why the market should do what the market is going to do, in my opinion, you're trading half blind. And over the years of teaching, that is the biggest problem that I've seen with students is, why does this order block fail? And why does this fair value gap fail? And why hasn't this breaker supported price? And this is partly one of the reasons that people say ICT concepts don't work, is because they're just trading patterns without really any context behind it. And the whole point of this mentorship is to shine a light on that, because I think people are very much misled in the industry at the moment. If you want to take this seriously, and you genuinely want to make money and change your life, do you honestly think that buying any bullish fair value gap or selling any bearish fair value gap is going to give you consistency in your trading? Because if you are just relying on simple, easy patterns, you may as well just trade with indicators. In my opinion, there's not a lot of difference. The beauty about ICT concepts is that it gives you framework. And more importantly, you're able to distinguish between high probability and low probability setups. And that's the key, is knowing when to trade and when not to trade. If you're trading a pattern, you're just going to trade everything every time you see this pattern. And I've been there, right? That's the exact same thing that I used to do. And when it didn't work, I used to say, well, these concepts are flawed. When I now look back at how little I really knew in my first couple of years, compared to where I am at now, I was very naive in thinking that I could do this faster. And don't get me wrong, I'm not saying that you shouldn't have belief in yourself, but there has to be some realistic expectations. And if you've followed me for a while, you know that I don't sugarcoat any of this, because I've been in the trenches and I know how difficult this actually is. You're trading against the most smartest, intelligent, ruthless people on the planet. And there has to come this shift where you understand that this isn't a game, right? You have to take this as a business. Anyway, let's get into the charts. So here we have the dollar index, and this is on the daily time frame. Now, the first thing you should know is we have run buy-side liquidity above these relative equal highs here, and we've run sell-side liquidity below these lows down here. This gives us our dealing range from this low to this high. You can see how we're currently sat around equilibrium. In order to effectively determine what price is likely to do next, we have to see what price has previously done. Inside the upper quadrant of this entire dealing range, you can see where we have had this consolidation. This was the lowest low inside of that consolidation. And you can see how we ran through this low on a closing basis. This left this sell side imbalance from this candle's low to this candle's high. You can see how we've run up to rebalance and we've touched the 75 DRT level. What did price do here? We ran higher, sweeping the buy side liquidity above this high and into this up close candle. And then what happens? price displaces lower back through this sell side imbalance. What does this sell side imbalance now become? Becomes an inverse fair value gap. And you can see that price here is failing to close back above this sell side imbalance. We run into it once, twice, 3 times before we displace lower back through this swing low down here on a closing basis. And rebalancing this entire buy side imbalance. Look at the bodies of the candles here, respecting the discount low. On Friday, we ran into this sell side imbalance, tapped the consequent encroachment, and then sold off closing back below the low of this sell side imbalance and the consequent encroachment of this buy side imbalance. This long wick here is considered as a gap. Now, if we take the midpoint of this gap, which would be the consequent encroachment, and we extend it across, you can see how we've had a confluence of the consequent encroachment of this sell side imbalance and the consequent encroachment of this wick or tail. From where we currently stand, price looks heavy. Below, we have all these relative equal lows down here, so there's a pool of layered sell side liquidity down here. And this sits in a discount relative to the entire dealing range. But below the sell side liquidity, we also have this down close candle as an order block. We haven't yet come into the body of this down close candle. So I want to see if we have the legs to travel lower and come into around the mean threshold of this down close candle. And I would want to see price repel from this area and move higher. Now also notice where this down close candle sits, at the 25 DRT level. I feel that these highs are too clean. My expectation is that we run higher for these highs, but we may want to drop lower before doing that. What would invalidate my bias going bearish is if we would close above the premium of this sell side imbalance. Then I would anticipate this sell side imbalance to act as an inverse level and potentially find support to run for the equal highs up here. Moving on to the euro dollar here on the daily time frame. Last week we were down here and I said we had this trend line that retail were looking at. And I said that if I was making the market, I would prefer to see them upset this trend line and then potentially run lower to the levels that we highlighted on the weekly time frame. I wanted to see if we would dig up into this sell side imbalance, the remainder of it, and you can see that we really ran through that level over here. Now, this makes me less bearish at the minute because ideally, if I'm bearish, I want to see a portion left open and then break down and give me something to enter on the right side of a sell program. However, we ran straight through this sell side imbalance and we've come into the consequent encroachment of this buy side imbalance. I now want to sit on my hands and wait for more information. Do we want to break down back below the discount low of this buy side imbalance? Or are we going to continue higher for this high up here, this high up here, and we have these relative equal highs with this sell side imbalance still unfilled? I would like to see price get back above the 75 DRT level on a closing basis and run through this down close candle. If that happens, we would have a change in state of delivery at a key DRT level, and then this would give me conviction that we are likely to then run higher. Let's get into what transpired last week on the euro dollar, and I can do a little bit of teaching on the price action. So this purple line here is the buy side liquidity that rests above this swing high. We have this sell side imbalance from this candle's low to this candle's high, and I'm going to grade that into equal quadrants. Now, these equal quadrants here are going to act in the same way as the dealing range DRT levels. This here is its own range in itself. The more you backtest and study fair value gaps and you break them down like this into grades and notice how price reacts from these levels, it'll give you a huge amount of insight. And I'm going to show you an example here today. I also want to bring your attention to these two down close candles and more specifically the opening price, right? So these two down close candles were formed where? At the discount low of this sell side imbalance. And then we had displacement higher, leaving this small fair value gap and running through the opening price of these consecutive down close candles. You can see how here on the daily time frame, the body's respecting that, and then we touch it once again and then really run away from that area. So I'm going to go down now onto a 1 hour time frame like this, and the same levels are kept here on the charts. I apologize that it does look a little bit busy, but for the purposes of teaching, it's just necessary, right? When I am trading, I have multiple monitors and I have different measurements and different levels that are salient to what I'm looking at, so I can keep my charts relatively clean, at least the chart that I'm trading off, right? So here we have the purple line, which was the old high, which overlapped with that 75 DRT level, and we have buy side liquidity resting above that. We have the premium high of that daily fair value gap, so the 100%, we've got the 75%, the equilibrium at 50%, 25%, and the discount low of that daily fair value gap. This red line here is the equilibrium, the 0.5 DRT level of the parent dealing range. And then we have this red line here, which is our daily order block, the opening price. Now, I want to split this into the daily dividers from Friday to Friday. Friday is important because Friday's range can often be used as projections for the coming week, right? Now, what do I mean by that? So firstly, this area here is just choppy. It's back and forth. It's a seek and destroy profile. If I take this swing high down to this swing low, one standard deviation lower will give me a price point of 1.07603. If I hover my cursor over this candle, the exact low comes in at 1.07603. Now, we ran the buy side liquidity above this swing high here on Monday. Notice how we close back above the 0.5 DRT level, and we close back above the fair value gap consequent encroachment, which is the midpoint of that daily fair value gap. Already, this gives me an indication that the market is likely to move higher. And again, from last week, we were anticipating a run higher to upset that retail trend line, right? From this candle's high to this candle's low, I want to now project deviations to see how high can we run. I see 3 standard deviations here, but this is below the buy side liquidity, or the old high to the left, and is below that 75 DRT level. 3.5 standard deviations is a good area because it sits above that buy side liquidity, right? And if we extend that level to the left, you can see how the high of the week came in on a Wednesday, touching 3.5 standard deviations. If we take that initial range on Friday and grade it like we would grade any dealing range, since this in itself is a dealing range, right? Why? Because we ran buy side here and we've ran sell side here. Price runs back into the dealing range and touches the midpoint. The midpoint comes in here at 1.07752. If I hover my cursor over this candle, the low comes in at 1.07752. We react off this level and then come down once more to touch that daily order block. And notice where that daily order block sits, at the 25 DRT level of this dealing range. And then price really runs away, tapping 75% of that daily fair value gap, and you can see the bodies there respecting that area. We run back lower, touching the high of this up close candle. This is known as an immediate rebalance. When this up close candle had printed, before any of this price action, we had a buy side imbalance, right? The candle directly next to it ran lower to completely rebalance that buy side imbalance and touch the high of this candle. So it immediately rebalanced after we swept sell side and ran above this swing high. This is a very, very powerful signature, and price will want to really move away from this area and not come back to it. If price comes back below an immediate rebalance, that's an algorithmic signature and an indication that we may be offside, right? As you can see, we never came back to this immediate rebalance. So placing your stop below an immediate rebalance low is a safe stop. And it's actually one of my favorite entry models. After the immediate rebalance, you can see how we ran higher on Wednesday. We consolidated around the 75% level of that daily fair value gap. Found support here look at the bodies, note where this order block is forming, then price really runs away, sweeping the buy-side liquidity above the old high to the left, before retracing Thursday, Friday. Where did it retrace to? Well, it didn't touch the rejection block here. It didn't touch the high of this breaker. It didn't come into this fair value gap, but it touched the midpoint of the premium high of the fair value gap and the 75% level. This is why the structure in price, the algorithmic structure, is important. We have another example here between the 75% and the 50% of that daily fair value gap. Let's look at Tuesday's price action and break this down in more detail on the 15-minute time frame. So here we have Monday's price action, and here we have Tuesday's price action. We have the 75% level of that daily fair value gap here, the consequent encroachment, and the 25% level here. The opening price at 12 a.m., we extend that out. Now, Monday's price action has tipped its hand. That price is likely to run higher. We also have all of this consolidation here behind us, right? So price opens up here, runs lower, sweeping all the sell side liquidity below these lows and this low down here. This is occurring in London. Notice how shallow the sweep is below this swing low down here. We're not getting any meaningful close below it. This candle here runs higher back through that 25% fair value gap level from the daily time frame. And then we continue to push higher, sweeping the buy side liquidity and breaking structure above these highs up here. Notice how we drop into this buy side imbalance and the body's respecting the opening price. Price then runs higher, leaving all of this buy side liquidity. Look how clean these highs are. That's engineered buy side liquidity, engineering it below the consequent encroachment of the daily fair value gap and below Monday's high. So there's a huge pool of buy side liquidity here. What does price then do? We have the PPI numbers come out and we get this whipsaw of price action that runs lower during the New York session, sweeping London's low and sweeping Monday's low, digging into that daily bullish order block. As this is occurring, notice on the British pound that this drop lower failed to sweep London's low. We had already swept Monday's low on Tuesday, so we didn't need to go back below this swing low. We came into this small imbalance over here, this small order block that sat where? At that old low, right? Generally, when you have an explosive move or an expansion in one direction, you will see two stages of SMT. We had the first stage SMT here, where the pound swept Monday's low, whereas the euro failed to. And then when the news released at 8:30, we failed to sweep London's low with the pound, whereas euro swept London's low. Now, where can it go? This run here that swept the sell side liquidity is going to be our fulcrum point. From this high to this low, if we project deviations higher, we get 2.5 deviations aligns perfectly with that 75% fair value gap level. Look at the bodies over here respecting that. When does this occur? In London close. We not only sweep the engineered buy side liquidity above the equal highs, we also run through Monday's high. When time, London close, aligns with price, the 75% fair value gap level, and we have a mathematical projection, this is how the algorithm books. And when you really fully understand ICT concepts, you are able to identify how this all operates. It's extremely precise. And it amazes me that people still think the markets are booked on buying and selling pressure. 7 years of doing this, and it still amazes me how precise the market is. You're not going to understand this straight away, right? There are charter students who are watching me, and I've had messages from them. They can fully appreciate it. There's certain things that they may have missed throughout their studies, and they can understand that this is very, very high level ICT. My point is this, right? This skill is transferable. The knowledge is transferable. ICT has already given us everything that we need. And if I can do it and I can see what's happening in price, so can you. It's just going to take a matter of time, and that's all it is. It's time, being consistent and showing up every day. There are a whole lot more things that I want to talk about during the course of this mentorship, and I'm extremely grateful that you even want to be here learning from me. If you submit to the time, I promise you, I can help you understand these concepts much, much better, and how to read this tapestry of price. Anyway, that's about as much as my voice can handle for today. I hope you guys have found this one insightful, and I will hopefully catch you again in next week's lecture. Take care, guys.